Hello and welcome to this month's investment review, which is looking back at the events of May and how we may be affected by the current investment outlook. Generally speaking, markets have shown that they have got some momentum, and US markets, as well as many others around the world, including of course our own, are now approaching all-time highs. I'd like to just remind everybody about the importance of diversified investments. As you no doubt remember from our previous investment reviews, we have repeatedly stated that it is very important that we keep focused on maintaining a balanced, diversified spread of investments within investment portfolios in order that we can hopefully ride out any sudden shocks. Given some consideration to market volatility, we can see that markets are still capable of showing some volatility, and this is likely to remain a feature for some time as economic and political matters begin to intermingle, especially in the UK, with a general election on the not too distant horizon. There has been much recent financial press surrounding the subject of interest rates, and this is a big concern on many people's mind. There was something of a surprise recently with the European interest rate cut, and there was talk of more quantitative easing within Europe. Markets generally like quantitative easing because it injects cheap money into the marketplace. The UK outlook for interest rates is something that everybody is focusing on at the moment, and there is a general belief that these may go up within the year. Of course, we do need to be mindful of the general election forthcoming and maybe some political influence that holds interest rates back. Interest rates have a direct relationship to our investments in so much as if interest rates were high and inflation low, then we would be willing to take less risk and we would be able to obtain a real return on our money for simply putting it in the bank. As we all know, the opposite is true, and where interest rates are low and on a comparable basis inflation is high. Thus money left in the bank is actually losing value, and so to overcome this anomaly we need to take risk within investment portfolios. Risk management is of particular importance to us and to our clients. In this respect, I mean that we have to make sure that all clients are happy with the risk position of their portfolios, and if this is something that you feel requires some more discussion, then please do not hesitate to contact us. There's a lot of talk about corporate bonds and a possible rotation away from corporate bond investments into equities. The bottom rung of the risk ladder involves gilts and corporate bonds, and the corporate bond market is one that has seen unprecedented inflows of money as people sought real returns on their savings, but at the same time shied away from the higher end risk assets. There is a great deal of money now invested in corporate bonds, and we need to remain cautious as to their outlook because if interest rates go up, there may be a sea change away from them, which could have a dramatic effect on the capital values. All of that said, I have recently undertaken a detailed review of the corporate bond funds that we are using within our portfolios, and all of these have so far performed exactly as we would have anticipated, i.e. with little volatility whilst generating real returns over and above inflation. Thus, their inclusion within the portfolio continues to be relevant. None of us need to be reminded that equity markets remain volatile, but they do hold some appeal, with many fund managers stating that a lot of equities now show good value. Never before in modern histories have companies held so much cash on their balance sheets, meaning that they are able to pay their investors generous dividends. This makes investing in equities appealing, so long as we remember that the price of an equity can be quite volatile. Being mindful that we are investing for the long term, it's essential to have some equities within our portfolio, and this is an area that we are always keeping under very tight review. During the last year, we have started working closely with the discretionary fund manager world, and this gives us very close insight into market opinion and as to how markets are functioning. It also allows us access to investment products that in the course of day-to-day business we would not ordinarily be able to obtain. It's our belief that some clients may benefit from the inclusion of the discretionary fund manager system within their portfolios. And as time passes during this year and client investment reviews on a personal basis come to the fore, we will be in touch as and when we think that this may be appropriate for you to discuss in greater detail. In the last investment review, I mentioned that there had been some changes to pension planning. The Queen's speech confirmed the recent very radical changes, and this has completely shifted how we as independent financial advisors must think about our clients' investment planning, particularly clients who are still at work and those who are not currently maximising their pension contributions. We are currently reviewing the best way to deal with this new legislation and will be in touch with our clients on an individual basis to dovetail these new very radical changes into their financial planning. As is usual within our investment reviews, we've included a graph. This shows the performance of one of our medium risk portfolios versus the FTSE 100. We're not suggesting that the FTSE 100 is a direct comparison, by the way. It's just well known of, read about, and serves as a good barometer which generally indicates how markets are performing. Please remember that the medium risk portfolio contains low risk instruments, and we would never really expect this to perform as well as an all equity investment over the long term. This chart shows the 1 month performance of our medium risk portfolio versus the FTSE 100, and it's pleasing to note a modest outperform. Perhaps more meaningful and graphically representative of how we aim to smooth out investment returns is this chart, which shows the investment performance of our medium risk portfolio since the beginning of the year compared to the well-known FTSE 100. You can see that broadly speaking they've reached the same place, with some positive growth having been enjoyed. The journey, however, has been markedly different, with the FTSE showing much greater levels of volatility. So, to bring this review to summary, and as world markets and those in the UK are approaching all-time high, I'll close the review off. As usual, all of our contact details appear on the final slide, and we'd welcome contact at any time. Thank you for listening.